Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Thursday, February 19, 2009. The Bank of Japan kept interest rates at 0.1% last evening and expanded measures meant to inject money into the economy. It said it would begin purchases of 1 trillion yen or $10.8 billion of corporate bonds. In addition, the Bank of Japan extended its deadline on its special loan program to the end of September from the originally stated March 31st and broadened the range of securities eligible to be used as collateral against these loans. Expectations are for another very weak quarter for the Japanese economy, and the steps being taken to ease corporate finance conditions are extremely unusual, said the Bank of Japan governor. The euro-yen pair jumped around 300 pips in today's session, testing resistance near 120.30, which was the highest the pair reached last week, and an area that has acted as resistance since mid-January. Stocks in Asia and Europe were generally up, which helped fuel a sense of risk appetite. Also, concerns over Eastern European banking losses eased, giving strength to the euro. The dollar-yen pair continued its rising trend, increasing for the fifth session out of the last six. That rally has seen the pair rise about 450 pips. Today's high near 94.50 runs up against a medium-term resistance level from January 2nd, so one should monitor if this recent trend stalls. The yen has come under increased pressure recently, even as global equities have been shaky, as the long-term fundamentals of the Japanese economy are starting to outweigh its safe haven status. In the U.S., weekly jobless claims were unchanged at 627,000 in the week ending February 14th, while the four-week moving average rose to 619,000, the highest it's been since November of 1982. The number of continuing claims, those people drawing benefits for more than 1 week in the week ending February 7th, soared 170,000 to 4.987 million. That's the highest level since the government started keeping track of this measure in 1967. U.S. producer prices rose 0.8% in January, as a wide range of products from energy to automobiles climbed higher. Both the headline and the core figures came in above expectations, helping to ease concerns about the economy falling into a deflationary spiral. On the year, producer prices fell 1%, which is a smaller fall than forecast, but also shows that inflation is not a concern yet either. The Philly Fed Index declined to an 18-year low, falling far below forecasts. The index read negative 41.3 for February, as new orders, shipments, and employment subgauges all fell lower. It's the 14th month out of the last 15 that the index has been negative. And in a final release from the U.S., the Conference Board Index of Leading Indicators rose 0.4% in January, surprising forecasts on the upside. The index tries to forecast economic activity 6 to 9 months ahead. The euro-dollar pair saw a return to euro strength today, though most likely we're seeing a retest of old support, which may now be turning into resistance at the 1.2750 area. Still, today's climb amounted to a 220 pip move. The pound-dollar pair broke its downward sloping line of resistance to start today's trading session and rallied 220 pips to set a new high for this week at 1.4445. It also jumped above its horizontal line of resistance from this week near 1.43, though it returned to that level in the New York session. The euro-pound pair fell lower in European trading, hitting a new weekly low at 0.8770. The euro managed to rebound, but its rally was stalled at the downward sloping line of resistance that has been established in the past 5 sessions. Tonight, Japan posted its All-Industrial Activity Index. Overnight, both Germany and the Eurozone revealed their preliminary versions of services and manufacturing PMI, and the UK posts its retail sales data for January. Tomorrow, the week concludes with consumer price data from both Canada and the US. And that wraps up today's version of our broadcast. Thank you for joining us here at CMSFX.com, and happy trading.